Good morning, ladies and gentlemen, and welcome to 2022. The risk dial closed pretty strong, 73. We are in mathematical risk off, but that is why you have me to interpret what the model is saying. The model has gone in risk off purely because of mathematical reasons, because the moving averages have rolled over, but that is not worrying as far as I'm concerned. I want to take this opportunity to examine some very long-term macro charts and to explain to you what I think is going on and what the main themes for 2022 will be. First of all, it's important to recognize that throughout 2021, risk assets have basically traded between 20 and 22 times multiplier of their forward earnings. While the forward earnings continue to increase, the expectations continue to increase, we have very, very shallow corrections and then spurts higher again. What that tells me is that basically we are absolutely tied to bonds. Risk assets will continue, as they did for the whole of 2021, to be absolutely tied to bond yields, and the explanation is actually very simple. First of all, let's look at the two measures of inflation that the Fed looks at. This is the five-year forward inflation expectation rate, and we basically started the year somewhere around the 2 level, and we are closing it around the 230 level. You can see that we've only gone up 30 basis points throughout the year. If we look at the other one, the longer term, which is the 10-year break-even inflation rate, we've gone up slightly more. We started the year at 2 and we're closing the year at 258. So we've gone up nearly 60 basis points in that. Neither of those are very dramatic, but we have a trend, okay? We have a trend of higher inflation, and that is why the Fed is in a tightening mode, as it were. But let us have a look at what the implications of that tightening mode are and where the market is setting the terminal rate. You will have seen this chart bandied about on Twitter and other places quite a lot. And basically this is the S&P earnings yield minus the CPI inflation rate, and which shows you that every time we've been down here, we've had a reversal in risk assets and, the yield has gone higher. Yes and no. I think this is a very misleading chart. I think the charts to look at are the next two charts, which is basically the S&P earnings yield versus the 10-year bond yield. And as you can see, there is quite a big gap between the yield of 10s and the yield of equities, much in favor of equities. And this chart leads to the next chart, which is this one, the earnings yield minus the 10-year bond yield. You can see that actually we are very high up. We are nowhere near expensive in terms of risk assets if you compare them to the yield of the 10-year. Therefore, throughout 2022, it's going to be absolutely critical to determine where the 10-year note and the 30-year note yields will be to be able to determine whether equities are cheap or expensive relative to them. In other words, we are going to be married to whatever the bond market does. The risk markets are actually going to copy almost tick for tick. It's going to be my kind of market, the kind of market where you predict where bond rates are going, and a 20-30 basis points move in bonds is going to have a 3-4-5% effect on equity markets. To me, equities are not expensive as long as we don't get one of two things. The first is a fall in economic activity, which is going to be predicted by Purchasing Managers Index. And the second one is a change in the terminal rate, i.e. in what the bond market is forecasting will be the terminal rate when the Fed is done tightening. As always, the best predictor of the terminal rate is the yield curve. This is 2's tens, and as long as 2's tens have a flattening tendency, that means that the 10-year note is going to be relatively stable and the 30-year note is going to be relatively stable. The worrying part would only be if we start seeing a steepening of the 2's tens. Even though the Fed is now in a tightening mode, if you get a steepening of the 2's tens, it'll mean that the market is considering that the Fed is remaining behind the curve. And that would be very worrying. That would lead to sharp increases in 10s and 30s in their yield. And that would definitely lead to equity sell-offs. Because, as I showed you earlier, we are very much now married to whatever the long end of the curve does. The equity market is not going to be worried in the slightest by Fed tightening as long as that does not lead to significantly higher levels of terminal rates. As long as the terminal rate that the market expects remains constant, 2's can go as high as they like. And if we have a look at what the 2's are, this is a longer term chart of 2-year notes. We will see that the Fed started easing here when they're at 130 and we're still at 70. I expect the 2-year to take the brunt of all the Fed activity over the course of the next few weeks and months, and slowly go into the 80s, 90s, and maybe even touch 1%. I still expect it to be below the 130 level, and because every single part of the yield curve is saying, yes, we will remain stable. That will change if we start seeing a steepening in the yield curve. Until then, the market is content, and therefore equities have limited downside. As far as the other parts of the yield curve, this is a weekly chart of the 5s, 30s. As long as we stay between 81 to 83 and 56, we do one of these periods again. The market is quite happy. The terminal rate is not moving very much. And, we continue with stability. The only worrying time for me will be if the 5s, 30s start coming back down again through 81, through 83. That will be worrying because that will be implying a much higher terminal rate or an inappropriate terminal rate. While the yield curve continues to be stable around these levels, absolutely no great harm can come to risk on. This is a chart of the 5-year note, and as you can see, the market anticipated the Fed in early October and has remained very, very stable since. Only if we start going above 145, 146 basis points will we be in any kind of trouble. And if we look at the 10s, the level is even clearer. The level is 170 basis points. So unless these markets start going for higher rates and therefore arguably a lower multiplier for risk, we are very much trading in a lovely range. I mean, look at what the market anticipated, gave back. The longer end likes the Fed being proactive, and it's still very much forecasting a terminal rate which is going to be below what the Fed thinks it will, i.e. almost a negative yield curve. And while that continues, there is absolutely no reason to sell off equities. 30-year notes, here we are. The chart is basically discounting anywhere between 170 and 2% as the terminal rate. What have we done since October, when the market started discounting higher Fed rates quicker? We've actually done a little bit better. Really, it's only if we start breaking these kind of levels, 220, let's call it, on the 30-year note, that there is something going on and that we have potential for a risk-off move in equities. Until then, there is absolutely no worry of that, simply because, as I showed you in earlier charts, throughout 2021, the risk markets have done nothing but go up with forward earnings. They have not gained anything in the multiplier, and therefore, as long as bonds are stable, all you can get in risk markets is a 5% setback. You can't get more than that unless PMIs roll over. And really, no one is expecting the economy to do anything but go great guns, certainly for the first quarter of 2022. This is a chart of the differential between bunds and 10-year notes. And as you can see, we basically have regained stability. What have we done throughout the year? Well, first of all, we had the inflation in the States and the expectations that the Fed would tighten, and then we've basically been in a range ever since, and we are stable. Now, you know that I think that the QE that the ECB continues to do leaks into the States and leaks into US assets. When will I start thinking that equities and bonds in the States, which, as I've told you, are now tied at the hip, are going to be in trouble? Only if we start breaking these levels, 159 basis points to the downside. That will mean that rates in Europe are rising faster than rates in the US. Why will that happen? Well, that can only happen if we have some sort of change in policy at the ECB, and they start tightening in inverted commas. Then in that case there will be less QE to leak, if any, and we could be in trouble in terms of higher rates throughout the world. And that is going to be reflected in equities as well, because that makes the likelihood that the PMIs roll over that much greater. So the whole thing is very much tied together, and this will be throughout 2022 a big signal to me. If we start breaking down through 159, I think that equities are going to be in great trouble. Why? Now, if we look at what the individual tenures are doing in Germany, we're going back to the highs. This is the Schatz. And it's going to be very, very important if we start breaking this level, which is minus 58 basis points. If the 2-year starts breaking minus 58, I expect it to trade close to it. But if it starts breaking on a weekly basis, that will be the first indication in a long time. And you can see how far back this chart goes. This goes back all the way to 2019. You can see that if we start breaking this level, we are in trouble. Something is going on. there is a change in policy at the ECB, or the market is expecting a change in policy in the ECB, and that is going to impact the whole world. The levels here in the bubble are just as clear. If we start breaking above these levels and closing above these levels, what's that, minus 40-ish, we are in trouble again. So we are very close to getting some important signals. To tell you the truth, I expect the ECB to very much defend these levels, and therefore I don't expect it to happen, certainly not in January, and certainly not unless we have some real movement in those charts that I showed you of five-year forward inflation rates and the 10-year break-evens. Unless we see those move significantly higher, I think the ECB will defend quite easily these levels. And this is what, -6, -7 basis points in the Bund. I think we will be able to defend those, and that's where you get out of the short positions in Bund futures, and basically you say reload back at -37. The market is in a 25-30 basis point range, and unless we start breaking the ranges, which will really be telling, especially if we start breaking them on the downside as well in terms of the differential between US and Europe, then that will be significant. At the moment, this tells me that we are in a period of stability, trading a range. I love trading the range from the short side in terms of futures to the upside, but unless we start breaking these levels, there's really not much going on. There are no long-term macro signals. How will we know if the market is expecting any change in slowdown in the US economy or any change in ECB policy? Well, the dollar will tell us. This kind of stability will be broken to the downside. So unless I see the dollar going down below 95.07 towards 93.63, I will assume that there is absolutely no change in this slow uptrend that is going on. We paused here at 96.47, which is absolutely normal, and basically we are just trading sideways. That can be easily seen in the chart of Euro USD, which is its biggest component. All the moving averages at the moment are saying one thing and one thing only, and that is that we are still in a downtrend. Whether the downtrend happens from this 115.20 level or we just continue straight down, I don't think is very material. Basically, this level here is going to be as important as it gets, and it very much is going to influence the way we see things throughout the first quarter of 2022. There is no reason for the dollar to weaken. The only reason for the dollar to weaken would be a narrowing of the spreads between the interest rates, the relative interest rates, and or expectations for what is going to happen to the US economy. As long as those don't change, I see it very, very difficult to break this level, 115, just below 115.5, and I don't expect that to happen. It would be very significant if that did happen, and that would cause me to question my assumptions. Throughout 2022, gold has been relatively stable and basically has been attracted to this 1764 level and keeps on bouncing off it, as it were, but in a very tight range. basically we are in 1764, 1861, what do you want to do? Now, why would gold go up? Would go up only for one reason, and that is that we are having a conjunction of two things. One, a slowdown in the States, and two, the Fed is behind the curve. Only if the terminal rate is not high enough, and that causes the economy to turn over, and therefore causes some kind of a very sharp risk off, can gold perform. And then I would expect it to really start attacking the 2,100 level. But unless we see bonds really struggling because the Fed is way behind the curve, and I see that the US economy is turning over, and therefore money has to go into the only other real asset, and that is gold, I really see no reason why this kind of stability between 1764 and 1881 is going to be broken anytime soon. If we see gold breaking these levels, that is going to be significant, and that is going to actually tell us that the likelihood of risk off is higher than we thought. This is a chart of gold over DBC, and basically we started the year up here, and throughout the year, as I suspected, DBC was the better inflation hedge. I don't see anything much changing here. I think it'll range between this 638 level and slightly higher. I think it'll be in a range like this. But what does that mean for DBC? I think DBC is still headed upward. I still think the US economy and the world economy are going to perform reasonably well in 2022, and that is going to put some upward pressure, although milder than we had in 2021, on DBC. I see it probably at some stage touching around this 2439 level, but you know, that would be a reasonable performance for it. That would be, well, close to 20%. I don't see it much above that unless inflation starts screaming, and I don't expect that. So really a range between 1840 and 2439. I still think dips are to be bought because we will see these higher levels of DBC. Let's start the equities review with this chart, which is VTI over SPY. So VTI is the Vanguard Total Stock Market Index. So all the shares out there in the US against the SPY. The SPY is very much, sort of a few stocks, right? I mean, it's weighted, and therefore, you know, Apple and Google, etc., have a undue influence on it. VTI, as you can see, stocks per se are just not expensive. We're now basically trading at the same level as we were trading in 2016 in terms of the ratio between them, and therefore nobody can say that the totality of stocks are in any way expensive. I think they're very much reflecting the reality, and are even cheap relative to what the yields on treasuries are doing. So I really, at this kind of level of VTI over SPY, it's very hard to see a crash of some kind. We are very much where we were before COVID, which was a complete shock struck, which was right here, and then we went down. at these levels, it's very, very hard indeed to see that we are going to have a crash in the total valuation of the stock market. It's just very, very unlikely. And this is XLP over XLY. Now, this is the chart that I will be looking at very closely, because if inflation is real, in inverted commas, you would expect the US consumer at some stage to start retrenching. And that should move XLP, XLY, and that should put us into risk off. So unless I see XLP, XLY taking out this level, where it basically failed every time throughout 2021, I will not be too worried. That would be a worrying sign if XLP, XLY started breaking this 0.42 level, and I will be looking at it like a hawk. Think of it this way: if the US consumer retrenches, then basically it's almost game over. It really doesn't matter how low or how high interest rates go. Of course, if they are lower, it's better. The move is going to be the risk-off move is going to be relatively smaller. But since the US consumer is basically, I don't know what percentage of the economy, but something stratospheric, if the US consumer gives up, and there is absolutely no reason that I can see for him to give up at the moment, then that is going to be risk-off. But until that happens, the likelihood of anything more than a 3, 4, 5% retracement in SPY is very remote. So let's have a look at my clean chart with all the most important levels in SPY. Really, we can enlarge this part and see what happened. Basically, we got to 4,700, which was 215 times 22, and 4730, and there we were. Omicron comes along. We just on a weekly basis cannot break this 4535 level. We go back up. Oh my God, more Omicron. We just can't close below 4535, straight back up. To me, 4535 is going to be the absolute most important level throughout 2022. If we start breaking below, that will mean something that I'm not expecting, and I don't know what that could be. But I think that we're going to have relative stability, certainly in the first quarter of 2022, simply because the expectations of forward earnings are still continuing. The only thing that can get us to basically separate from bond yields, and if bond yields, as I showed you earlier, are going to be stable, then the stock market is going to be relatively stable and only ascend with forward earnings, i.e. the multiplier is going to be very steady. The only thing that can change the multiplier, if that doesn't change, then the only thing that can change is the forward earnings, and that would mean some kind of complete collapse in Purchasing Managers Index and or the US consumer. That is the only thing that's going to make us really go below 45.35, and that is going to be very, very significant. So as long as we keep on getting non-farm payroll numbers which indicate a strong employment condition, that the likelihood that we get the US consumer to roll over is very, very small. And therefore, I don't expect anything to endanger this 45.35 level. A weekly close below 45.35 at some stage, whenever that might happen, to me is going to be very bearish. But for the time being, I expect 47.05 to 12 area to be defended, and certainly to all bounces to happen within this 47.12 to 46 area. Retrace, bounce, go higher. I certainly would not, argue against something like 225 times 22, that kind of area throughout by the end of Q1 2022. And if we look at the transports and the Dow Industrials, the levels are very, very clear to me. If we start getting non-confirmation from the transports below 15,350, something is going on. We need to understand then what is going on. Until and unless that happens, you have to go with it and say that at some stage we take out 17,000 and move towards 18,000. The same thing for the Dow. The level is very clear, and I'll enlarge this. The level is 34,777. While we are above it on a weekly basis, we don't have very much to worry about. And that, look at it, is where the 200-day moving average now comes in. So everything is basically falling into place technically, and the technicals are saying that they will give us very good warning. While we're above there is absolutely nothing to worry about, and I see no reason why we shouldn't stay above there. If we start falling below it, there will be some various obvious reasons, and that will be either that the US consumer is rolling over or that the PMIs are rolling over. Until one of those two happens, and we now know, and we are looking at these levels, we're looking at these charts on a daily basis, and we know what the spread XLP, XLY should be, or below what level it should be, then really we don't have too much to fear. We continue buying the dips at the levels that are important. Europe and in general, and this is the stocks and this is the DAX, have given us very, very clear levels below which we have to be worried. The only level that we really have to be worried below is 3,986. Below that, and something really is going on that we don't understand, or either we don't understand or we hadn't forecast, but it should be clear by then what that thing is. Absolutely, I see absolutely no reason not to continue buying dips to 4,141 in the stocks. The stocks is leading the DAX, which is another sign of risk on. So really nothing there that is telling me that this risk on situation in general in the world is changing. The Nikkei is also very clear. Unless we start getting weekly closes below 28,180 and much more importantly 26,940, and you can see that level 26,910 on the dailies, nothing has changed there. You continue buying these dips because the path of least resistance is still higher. Absolutely no reason to change my mind that we are absolutely tied at the hip with the US bonds, and until and unless US bonds start giving us a reason to worry, it's still the right trade is to continue buying the dips at those very important levels. Even EEM, which is the market which lost me the most money in 2021, is really not that bad as far as as far as I look at it. To me, 47.93 is going to be a very important level, but really the most important level is 45.04. While all dips are contained to 45.04, I have every confidence that we will see throughout the course of a year at least 52.14, if not higher. So even that is telling me to buy the dip. I just can't see any reason why you would be extremely worried about any risk market at the moment. The terminal rate, as I explained, is still very, very contained. The US dollar is giving you no cause to doubt the US consumer, or B, PMIs. And as that continues, every dip in the stock markets at, at important levels, not just anywhere, should continue to be rewarded. And on to my biases. And I really think that the twos tens is going to be one of the best indicators all year. And that is because in a period of Fed tightening, again, we're all expecting Fed tightening. The only way that you are going to have significantly higher yields, and what do significantly higher yields mean? Significantly higher yields mean that the terminal rate moves up, and that allows risk off, is if the market perceives the Fed to be behind the curve and inflation to be much more of a problem than the Fed is actually willing to deal with. And therefore, the only way that that can happen is if 210 starts steepening beyond 99 basis points. I really don't see that happening, but that is neither here nor there. The market will tell us. So as long as twos tens have a flattening tendency, that means that the terminal rate is pretty constant. That has to keep a check on any kind of risk-off move, because as I showed you, equities in terms of bonds are not expensive. They are actually getting to be relatively cheap. And the only thing that can cause risk-off and therefore not buying these kind of levels is, or the market going through these kind of levels, is if the economy turns over. But that is going to be obvious by so many other indicators that we really don't have to worry about that until we get those signals. Thank you very much indeed, and I hope you now understand my thinking for 2022. And of course, I will tweet you on Monday, and we will follow these indicators throughout the first quarter to see what the best strategy is.